Imagine if you could have invested in Palantir before they had their IPO, or Microsoft, or Nvidia, or Tesla. Some of the most exciting companies to exist in our lifetimes may not even be publicly traded yet. Today we're going to show you how to buy shares of the world's most exciting startups and, more importantly, how to value them. This presentation is a mountain of insightful information. Honestly, I haven't been this excited since the Olsen twins turned 18. But first, a story. Around 5 years ago, I spent about 6 months researching global AI startups in a series called Global AI Race. During that time, I visited all 3 countries in the Caucasus, Armenia, Azerbaijan, and Georgia, to uncover the top disruptive tech startups in that region. Bacteriophages, chatbots, and smart rings all made our list of top 12 startups from the Caucasus. It also included one called CRISP, which you may be familiar with. During that trip, I was interviewed by an Azerbaijani television station that happened to be at an accelerator I was visiting. "What are you doing here?" she asked. I don't know why she's German. "I'm scouting for exciting startups," I said confidently. "What's a startup?" she asked. And it was a damn good question. What's a startup? A 100-year-old company that's not public yet isn't a startup. Just because it's private doesn't mean it's a startup. It's been around too long. A startup is a private company that typically enjoys the following characteristics. Most will fail in the first few years, up to 90%. So if you're going to invest in startups, you're going to want to spray and pray. Those that succeed, in other words, they show their investors a positive ROI, will typically exit in 7 to 11 years through mergers and acquisitions or an IPO. Now, in order to exit, you need to have proved you can sell a product or service for more than it costs to produce. You need to also have a large total addressable market that you can grow into. So small startups only become big because they're typically disrupting and capturing opportunity. Either they're stealing that from competitors or they're creating new opportunities, which is referred to as blue ocean TAM. Now, a startup by definition needs to have strong revenue growth. If you don't have revenue growth, you don't have shit. And that's why publicly traded companies with no revenues are hot garbage. How many startups with no revenues can you name? Probably none. That's because in order to be on everyone's radar, you need to have revenues and growth. So to gain the least bit of funding traction, you need product market fit. That's when venture capitalists, these are institutional investors who invest in startups, will then start throwing money at you. Now, coming up, before we invest in any startup, we need to know how to value them. So we're going to look at the highest valued startups out there, which aren't necessarily the most popular. We're going to talk about when to invest so you can avoid that 90% loss number. And we're going to tell you exactly how to invest in hundreds of startups. Now, there's really 3 ways that you can value a startup. The first is to model their cash flows. You can use MBA strength modeling techniques. This is what venture capitalists do. The second way is just, of course, to cheat and look at the valuations ascribed by these venture capital investors. And these can move up or down over time, depending on their outlooks, what their fancy spreadsheets will tell them. And then you can also look at trades on secondary markets. So these are companies that allow people who hold shares of startups to sell them and people that are looking to buy shares in startups to buy them. But these are likely to be inflated at times, and we're going to talk about that. Now, when it comes to funding startups, there's really 7 stages of funding described here. You can pause this and look at these various stages. Most notable would be pre-seed and seed, where a company may actually take money without having revenues because they're trying to prove their concept. And of course, we're all familiar with the IPO stage. That's where venture capitalists usually return hopefully a positive ROI on their investment. Now, some startups fly through their funding rounds very quickly. Some wander around lost for years. I like this piece here by Carta. So they're a big provider of software for cap tables, and that's simply a tool used by venture capitalists to value startups and to see whose piece of the pie is worth what. And you can see here what's notable is on the right-hand side, the median age of a company when it receives its various series of funding. So you could see Series D around 8 years. So that all makes sense. Now, this data from 54 Collective is very telling. So 30% of startups fail within 3 years. 50% don't make it past 5 years. 70% close down in 10 years. So you can also close down and go bankrupt without an exit and last for quite a while. Only 40% of startups manage to turn a profit. So as you can see here, the longer a startup exists, the less likely it is to implode. So The later stages where you get involved with investing are going to be the least risky. Now, when it comes to the most valuable startups in the world, the master list for this is the CB Insights Global Unicorn Club. A unicorn is a startup that has managed to achieve a valuation of $1 billion or more. I think there's around 1,200 of them now. Quite a few of them are AI startups. And you can go down the list here. I highlighted a couple things that are worth noting. So first of all, in green, they're on the left, company names. These are ones that you'd all be quite familiar with. The blue highlighted companies you may be less familiar with, but they're still notable names. And then in the center there, you can see what countries these startups hail from. China, Singapore, Australia, and just the country breakdown. And on the right, you see where I've highlighted Sequoia. They're actually a active U.S. venture capitalist, perhaps one of the most successful out there that's dabbling a lot in China. I thought that was rather interesting. Now, these values don't always go up, and there's this concept of a down round. So when a venture capitalist invests in a startup, they ascribe a particular valuation. So if they're valuing the company for more than it was valued before, presumably because they're gaining more traction and things are looking up, then that's what you would expect, the value of a startup to go up over time. Now, if it stays the same, then that means the valuation of the company stayed the same. But if the valuation goes down, in other words, if the venture capitalist says, you know what, I think the value of this startup is less than the last time it had money injected into it, that's called a down round, and it's a bad thing. It means that something has gone wrong from the last round to the current round, making the company valued less. And this diagram from Forge, so they're a secondary market. It's a very useful diagram, shows the number of funding rounds over time. Make a note in the center of the boom in 2021. We're going to talk more about that. But on the right-hand side, you can see in green would be up rounds, if you will, where the funding round had a higher valuation than the last one. Gray being the valuation didn't change, and red being down rounds. So down rounds are typically, when they increase in number, a sign of past hype, and that's exactly what happened. You see here more interesting data from Forge. They talk about the majority of Q3 down rounds were linked to companies that last raised in 2021 when there was a bit of a bubble. So 37% of these startups that trade on Forge's platform last raised primary capital in 2021. And for this cohort, they say the median current Forge price sits 60% below the last funding round. In other words, you're getting about 50% off or more when you purchase shares in these startups. This isn't necessarily a good thing, especially when you don't have any financial data to justify that. But they say here that this suggests these companies haven't reckoned with the inflated valuations of 3 years ago. Remember what I said about all the funding that was happening in 2021 at inflated valuations. So enough of Startups 101. I'm sure you're wondering when you can buy shares of SpaceX or any other exciting startup out there. So first of all, further reading. We wrote this piece recently, Why You Shouldn't Invest in the Most Exciting Startup. And some of the topics covered in there: venture capital as an asset class, why invest in startups in the first place. That's very important to understand. Venture capital funds, that's what we would look at if we wanted to get exposure to this asset class. And then you have venture capital and AI. A lot of what you're getting today is exposure to AI startups. So in order to get entrance into the club, you need to be an accredited investor, and accredited status here, you can see there are quite a few of these individuals. Nearly 19.5 million households in 2023 were accredited. Roughly 15% of American households, they control over $100 trillion in wealth. And that's around 79% of all private wealth in America. Now, the requirements to be an accredited investor: $1 million in net worth outside the equity in your primary residence, or one household member earning $200,000 in the last 2 years with expectations of that to continue, or with a spouse earning $300,000 the last 2 straight years. And the definition here from Investopedia is a good one. Talks about income, net worth. We covered those in qualifications. Well, there aren't really any that I could see. It's simply, are you experienced? Yes, check the box sort of thing. But the burden of proving whether or not somebody's accredited falls on the investment vehicle. So when you go to these secondary markets such as Forge or EquityZen, they're going to validate that. The pros, the benefits, they say, are access to restricted investments at high returns. That's not necessarily a good thing if you understand how risk and rewards work. They say an increased diversification. That's perhaps the biggest benefit. So the cons, of course, high risk, high minimum investment amounts, high fees, and illiquidity. We're not going to talk much about fees. We're going to leave that to everyone to validate when they're exploring these platforms. So when we're picking a particular startup to look at, Anduril is one that I picked as an example. Are they the next Palantir? Well, both have origins in Middle Earth. They're both involved in defense. Both get talked about ad nauseum. So let's pretend we want to buy shares in Anduril. Where should we buy them and how much should we pay? Well, the basic thesis for this company, they build software and hardware using AI, and they compete with, they say, the big defense contractors, the old, slow incumbents that don't have the best talent. What do we need to invest? What data? Well, it'd be nice to have revenues per annum, gross margins over time, cash burn. Well, you're going to get none of this. You're going to get very little information. So when you first start out Googling how to invest in Anduril stock, you're going to see a bunch of sponsored ads, of course. These are the platforms competing to try to get your dollars, your commissions. And then here on the right, you see Equities and Forge Global. Those are the two secondary market providers that we want to focus on. We worked in an affiliate capacity with both these platforms. Forge actually happens to be public, so you can get a view into their financials, which aren't necessarily looking so rosy. But when we go to Forge and look at investing in Anduril, here you can see the last closed trade was at $33 a share, and that's at a 52% premium to the last primary round. Remember, we talked about the two ways to value. Either it's the valuation that venture capitalists ascribed, or the valuation ascribed by the secondary market, which is somebody coming in and purchasing shares in the platform. And that can be at a premium or at a discount. So what you can do next is then express interest. Here you can see the volume weighted average price there of $28.42. That's what you would expect to pay, but if you want your order filled, you might have to bid above that. And you see here, I just put in an example, 1,000 shares, willing to pay $28 a share, and it says, well, you need at least 100K to invest. So I'll say, well, maybe I can go to Equities N. I don't want to invest that much. So I jump over to Equities N, and things get even worse. So the minimum investment size there is around $423,000. And you see the implied valuation there at the expected share price of $48 is at a significant premium. So two takeaways here. First of all, there's going to be a lot of variability from the last institutional round. And also, the minimum investment amounts can be quite big. So these platforms typically talk about minimum amounts of $20,000. But as you can see here, for more popular startups, those numbers can increase very quickly. There's a couple problems here. Now you're tempted to start looking for newer vendors with smaller minimums. You need to do your own due diligence on some of the new names cropping up like Hive and such. Consider systemic risk, and you want to read into that yourselves. You may be tempted then to start looking at what other companies are available, what other startups. For example, Equities N filters on startups. They work exclusively with companies that have already raised capital from large institutional investors. They need to have at least $50 million in enterprise value. Think of that as market cap to be listed on the marketplace. Whatever you do, never, ever get involved with equity crowdfunding. So as you can see here, there's quite a few startups in Equities N that you might invest in, and I've circled one there, Adapar. This is rather interesting. I researched this platform previously just based on my past experience and working with similar sorts of financial operating systems. We wrote this piece back in, I think, 2017. You can read it. It's rather interesting. But you can invest in Adapar right now at a 20% discount rather than investing at a premium. That means that investors are willing to sell shares for less than the last time institutions invest. So maybe this was one that was saw a lot of hype in 2021, as we talked about. Certainly, one of the founders there of Palantir founded Adapars. He noticed there was a big need for a financial operating system for people with ultra high net worth individuals. Their money was being managed on spreadsheets, so he built Adapar. It's a rather interesting platform. But just to wrap this up, probably one of the biggest problems you'll have when investing in startups is there's no information advantage because you have no information. You're stuck aping professional investors who may have already realized a lot of their ROI. You may either pay a premium or a discount. Whether you do or don't, you're not going to know why. Now, this asset class, startups as an asset class, decreases volatility and liquidity. It's interesting that reduction in volatility is simply because there is no liquidity. So it's the same idea of reducing volatility in your portfolio by not checking it so often. If you're going to invest, set a maximum exposure percentage and do not exceed that. I think the exception might be in equity grants. So back when I worked in startups, I had shares in or equity grants in 3 different startups. Only one realized an ROI, and it wasn't life-changing. There are no lottery tickets. I think that just holds true in general when you're investing in startups. Whatever you do, don't equity crowdfund. And if you're not accredited, as a lot of people aren't, you may be wondering how you can get access to startups as an asset class. Well, you're going to want to watch this video next. Thanks so much for taking the time to watch this today.